Glad to know you stay with us. Like I said earlier, we have Charles Fakroha right here with us, and we'll be talking about ratio analysis in personal finance. He's right here. Good to have you join us again.
Good morning. It's a bright Friday morning, Samson.
Okay, so when you say ratio analysis, I was thrown off balance. What's that about?
Yes, in corporate finance, and when you come to company analysis, accountants or financial experts compute certain ratios, whether using the balance sheet items or profit and loss item. They compare one item with another. You say, even in Nigeria, you say debt to GDP ratio. You say earnings per share. These are just ratios that will guide the analyst to see whether this company or this country is doing well, is healthy, and all that. And most of these people who do this analysis, they forget that they can also do that analysis in their own personal finance. So they don't know. So we are now saying, when you meet a financial expert or financial planner for the first time, the first thing we take to do is to do what we call a financial self-appraisal. Just like when you go to a doctor's office, the doctor will ask the nurse to do what they call vital sign. They take your blood pressure, your pulse rate, your temperature. All these are vital signs, and it's going to assist him in his diagnosis. So the same also applies to your personal finance. You need to know certain ratios: solvency ratio, savings ratio, passive income ratio, net worth ratio. These are ratios that the individuals can calculate, and it will give the financial planner an overview of that person's financial health.
All right, so let's get to it already. So how do we calculate these ratios?
Okay, let's take a first ratio, for example, solvency ratio. In corporate finance, solvency has to do with you having cash to meet up your short-term liabilities.
Is that same as liquidity?
Yes, same as liquidity ratio, exactly. You can use, you need to. But we discovered that for companies, yes, they have access to bank finance and other means of financing. But for the individual, you need to have a certain amount of cash for you to meet up your day-to-day expenses. And once you don't have that cash, of course, you say you are broke. You can't pay this bill, you can't do this, you can't do that. And that's why one of the first steps in financial planning is save toward that emergency fund, 3 to 6 months, so that when an emergency like this comes up, you'll be able to dip into that fund and sort the problem. So you need to have certain amount of cash to meet up your personal expenses. That is solvent. And if you cannot meet up, you say you are illiquid. Just like you say a company is illiquid, they don't have immediate cash to meet up their expenses. That's one ratio you need to calculate. And what normally they advise that you should have, the ratio should be about 50%, 0.5. That is, if your day-to-day expenses is about 10,000 naira, you should have at least, some experts have said at least you still also have that 10,000 naira in cash. Whether the plus or minus, you can have 5,000 naira, because those expenses might not come at the same time. And it's not a regular amount. So plus or minus, they have said, well, you can have about 50% of it. Because if you don't do that, there is a tendency for you to now go and fund that expenses, maybe getting
a loan.
Not to manage to have a loan, maybe going to use what they call bank overdraft. Yes. And of course, you know that the interest rate for those facilities is very high. In other clients, that's why you see them going too deep in their credit card. Because credit card, you don't have the money there, but the bank will fund it for you. And they even encourage you, so that at the end of the day, the interest rate you pay will be so much for them. And you go into debt deep and deep and deep. That's one ratio. You can also have the savings ratio. Of course, in this platform we have said you should be able to save at least minimum 10% to 15% of your salary. That's after tax. You should be able to save that. And we've also discovered that even imagine somebody who earns 100,000 naira in a month, and is able to save about 25% of that, compared to somebody who earns 200 and is not able to save about 10%, over time, the man with the 100,000 naira will have a better net worth than the guy with the 200,000 naira. So you can see some of these ratios, you can say, oh, this person is earning so much, then he should be doing better. But if you now calculate the savings ratio, you know that this other person is doing better over time. You can also have what we call the targeted net worth ratio. That is very critical. You know, in personal financial planning, goal setting is very important.
Yes.
You need to set a goal to know that, yes, I want to know my net worth. And how do you calculate your net worth? Now, experts have given some formulas, and they said, if your age, okay, let's say you are 30 years and you are earning 50,000 naira a month.
Okay.
That's about 600,000 in a year. Now, for you to know at that age 30 what your net worth is supposed to be, you need to now do a simple calculation. And how do you do it? Your age now, 30.
Okay.
Okay. What is your annual income? 600,000. Now, that 600,000 divided by 10.
60,000.
60,000 multiplied by your age. That's your 30 years. 30 times 60.
1.8 in it.
Yeah, 1.8.
1.8 million. That is your expected net worth. So if you do that calculation,
is it really your net worth? Because at the end of the day, what about the expenditure and every other thing that's
like we said, it's a targeted
okay,
net worth. So now if you calculate now 1.8 million, let's say naira now, that is expected to be your net worth. And if you now check your net worth, what you have on ground, you are not up to that 1.8. That gives you that look, you are far behind what you are expected to be. So you now begin to work out plan to meet and exceed that net worth.
But isn't that some sort of faulty calculation, in the sense that if you are making use of the age, which is a variable here,
yes,
that's relative, because some people do not start working until probably age 25. So if you are putting into context the entire 30 years of existence, and you're multiplying that by the income, you know, that comes in on an annual basis as a targeted net worth, it looks faulty, because the previous 25 years, this fellow hasn't been working. So how do you
agreed that? So imagine if the person is 20 years, as long as you have started working.
That's why I gave an example that someone who begins work at 25 probably deals with schooling and all of that, but begins to work and earn
at 25.
At 25.
Okay, so you use 25 now. So 25, let's say, is earning, how much is he earning annually?
What I'm saying is, even if you use 25 rather than age 30, it still doesn't add up, considering that the previous 25 years the fellow hadn't been working.
Yes, I understand your point.
I think what he's saying is you start from when you start working.
It's the same thing. If you are doing the calculation and you are making the basis against the age, you said, for example, a fellow earns 600,000 annually, you divide by 10, 60,000, and you are multiplying by the age.
What if does it mean that every year you keep multiplying by the new age?
Exactly.
Your net worth keeps changing.
That's the
your
issue.
Annual income too keep changing. So like we said, it's just a targeted. We're not saying that is your actual. It's a targeted. It gives you an overview of all, an indication of this is what you are expected to be. So, and that's why we say goal setting. If you do that calculation,
I think it just helps you somehow to know that you're getting older, you should have more, or is that it?
Exactly. So let's take the man who is 50 and is earning the same 600,000. He will now know that he's far below his expected net to be looking at
3 million maybe at the end of the day.
So it just gives you an indication as to where you are supposed to be. And you now walk towards it if you are falling behind.
All right. In closing, when you realize that you're falling behind, what should you do?
Yes, you now begin to check your expenses. You now begin to see how you can increase your income. You now begin to see how you can have a passive income, maybe doing another side hustle to augment so that you walk towards that your expected net worth that you're expected to be.
Okay.
All right.
Yes.
I think this conversation will continue some other time because we really need to break
Definitely.
it further down. Thank you so
Yes.
much, Charles
Thank
Fakuha,
you.
for coming on
Okay.
the show.
Thank you very much.
Thank you very much.
Yeah.
We'll take a break now. When we return, we'll delve into more conversations for you. Please stay with us.